The biggest thing we vet is the actual physical asset itself. Talked about how much money, like the minimum size, it depends on the asset and it depends on physically where it is. At the end of the day, it's all mathematical. You're looking at trying to physically look at the asset, but it's the same. It's honestly the same thing for debt. It's a mathematical process to figure out, okay, what is the value of the property now? What is the value of the property at the end of either the construction build or at the end of the renovation?
Hi, welcome to NextGen Wealthcast. I'm your host Akash Jain, and I'm super excited to welcome my friend Chris Borden to the show today. Chris comes all the way from Hawaii. Aloha, Chris. How are you?
Aloha. I'm glad we both have Hawaiian shirts on.
Hey, I dressed up for you, sir.
Me too.
Welcome to the show, Chris. Today we're going to talk a little bit about different asset classes that we both love from an investing perspective, as well as a little bit about your story out to how you got into investing and what your background was. So let's start us off and talk to our viewers about some of your background as well as how you got into it. Your story, please, sir.
Not a problem. So I'll try to keep it as short as possible. I think I came up through the traditional American way as far as finding a corporate job and working hard and working your way up the ladder. Prior to getting into real estate investments, well, I've been in real estate investments for a very long time, but prior to getting more active on the real estate investing side of things, I ran a large grocery retail chain across Hawaii and California. It was pretty large. I mean, I started off bottom management and then just worked my way up all the way to CEO of the organization. When I left, we were doing over $1 billion in sales annually. And left for various reasons. Everyone asked. So I was originally from Hawaii, lived in Hawaii my entire life, except for went to school, college in California. Everyone asked why we moved away. So we now reside in Utah, but our kids moved to, one went into military, was stationed in Arizona. One went off to college and was in Oregon, and both didn't want to come back to Hawaii. So we wanted to be closer to our kids. And after almost 30 years in retail, I decided that we did very well for ourselves. Again, we were investing at the time, more so on a personal level, bought single family houses here and there. And we wanted to retire. So 4 years ago, we took the step to what we call retirement. But I guess retirement, let's just say freedom from being locked down from the 9 to 5, because I don't know if I will ever retire per se. But we moved here to, again, be closer to our kids, and that's where real estate sort of took like less of a backseat, because again, we did buy some single family houses and we had a few rentals at the time, but nothing on the scale that we're doing now. So, well, again, 4 years ago, we decided to move away, came to Utah. And again, Utah was because it's in the middle of Arizona and Oregon, where my kids were. So we wanted somewhere geographically in the middle. No other specific reason except for that. And the economy here was doing phenomenal when we moved. It was like right around the whole COVID time is when we moved. And Utah was one of the markets that were just doing absolutely phenomenal. So those are the deciding factors for us. But we knew we wanted to do something in real estate. We just didn't know exactly what we wanted to do. And I think that's the same thing for everybody. They kind of transition through different phases when they're investing, even active as well as passive. When we first started, we came to Utah. We bought some single family houses. I still wasn't 100% sure what we wanted to do. I wasn't a gigantic fan of it. More the kind of dealing with the early morning calls on the tenant side of things. And I wanted to do something outside of that. So we started attending different events in the area. And this was pretty early on. In fact, I think I sent my wife to an event prior to me even physically relocating here, because my wife relocated first. I relocated almost 6 months after my wife relocated. And as we went to these events, we started networking, getting to meet more people, learning a little bit more about different opportunities out there. And that's when we started to get more involved in commercial. For me, commercial was more up my alley because a commercial, there's much less emotion in commercial than there is in just residential real estate. Even if you're a landlord, the tenants are, it's different. It's a different atmosphere, and there's nuances to it specifically. But on the commercial side, it's basically a business. You're running and operating a business, which is what I was very comfortable with. Um, Being my background again on the CEO side, I had to deal with a lot of triple net. We did development, large scale. I can't remember exactly. I know we had over 30 stores all across, or 34 stores all across, again, Hawaii and California. But just dealing with it from a different aspect as far as a business made commercial a bit more lucrative, as far as more interesting to me. I mean, not lucrative, but more intriguing and interesting for me to go down. So I started going down that route, and in that route, I started meeting people who needed money. I was like, perfect. I have money. Other people needed money, and it was at that point it was kind of sort of a win-win situation. And we started getting actively into the debt side of things, where we're sitting on the debt. If you're newer to it, there's something called like a capital stack or a lean position, and I would recommend, and especially learning how all of that work, because you're taking on different risks depending on how you're investing and what you're investing in. So looking at that, I learned a little bit more about the debt side, and through that debt transactions, I mean, through learning about that and me being able to invest personally in it, I took a more active approach on that aspect of it. So primarily now, the bulk of what we do, I mean, we have assets all across the United States, but the bulk of what we do is debt investing or debt lending or debt investing, primarily on residential businesses, but we also do some commercial here and there. So that's kind of
Very,
it all in a nutshell.
very cool, Chris. No, that is a phenomenal story, right? Hey, from being a CEO of a multi-billion-dollar retail chain in Hawaii to being the CEO of your debt fund. Wow. And, hey, being able to lend on residential and wow. So, that is very interesting because, hey, we haven't talked on my show so far about debt funds. And I think that probably, will give us a little bit more to chew on. We have to, I do a lot of multifamily. We have other asset classes like startups and oil and gas that we've talked about. I personally have stayed away from that because I don't understand it. And like you just said, hey, you started investing in debt, you understand it. That's why you run a debt fund. So, hey, to help us understand the debt fund and how do you vet the underlying assets? Because to me, a lot of the times, hey, I see a lot of the operators, multifamily operators or other asset class operators, and they have on the one hand their multifamily, properties, and the other hand they have their debt fund. And to me, sometimes it feels like, hey, they are keep their multifamily afloat, they're raising debt. And to me, it's like, come on, and that doesn't make sense. So help me understand, hey, how to make sure and how to think about that.
um, I mean, I think it could make sense. It depends, So I think we talked about it earlier. For me, diversification is a large portion of it. The way So we started the fund. I think we started the fund. I mean, I don't think it's the typical round. I was just talking to an investor literally less than an hour ago, specifically about this. We started the fund more out of a selfish reason, meaning that I've been investing in debt. So prior to even starting a fund, I did just in the short span of time. So it was about 2.5 years. I did almost somewhere between 14 and 15 million. I don't know the exact amount, but just lending out my own money on different opportunities and different assets. Well, not necessarily assets. I think at the time, I just only had one commercial that I lent on at that time, and I was lending specifically on residential, primarily either a fix and flip or brand new development. So I've done both. Um, I think I think when you're looking at an asset and any asset that you're looking at, the biggest risk that you're taking on is debt. If you can control the debt on your side, you basically eliminate all of the risk. So, like where you've brought up multifamily, I don't think it's any surprise. Multifamily, just commercial in general, depending on what asset class you're looking at, I think we're starting to see a lot of recovery on office space as opposed to where it was back in COVID time, even slightly post COVID time. I think we're seeing a rebound there, and we're seeing ebbs and flows. Every asset class you're taking on risk, and there's different risks that you're taking on. Every asset class has their own cyclicality, meaning they have cycles of up and down, and there's a whole bunch of nuances in between that cover it. But for me, it was more about the risk allocation and me allocating and diversifying away from certain risk asset classes and taking my personal portfolio and my personal money and looking at it the same way a financial advisor. I know sometimes there's a lot of bashing and going back and forth on financial advisors, but you look at it from a fundamental standpoint, a lot of what they talk about makes sense. They talk about diversification and how you diversify. So probably one of the most well-known portfolios out there is a 60-40 portfolio, meaning that 60% of that money is into the equity market, and hopefully that's diversified between like emerging markets and different asset classes within that. And then you're taking the 40% is typically invested in debt. Right, it's either commercial debt against a business or a treasury lending money to the government. It's still debt. So I wanted to take my own personal portfolio and diversify it the same way. So I'm a little bit older in life, so I took a slightly larger, roughly about somewhere between, I don't know the exact number, but it's somewhere between 60 and 70, probably closer to the 70 mark. All of my money I have allocated towards debt. So the debt side of it, when I'm looking at it, I'm taking on lower risk. So again, learn about lean positions and a capital stack. When you look at it, if there's a foreclosure that happens, if something happens with the property, there's a lot of operators that got into multifamily that are having to foreclose. Normally what happens is the bank takes back the property. And that's the position that we typically sit not typically, we always sit in when we're lending out money on our debt side. So we're sitting in first lien position. If something happens, knock on wood, nothing has happened to date, but if something does happen, we have access to get that property and take possession of the property, thereby mitigating our risk. If you sit on the equity side of things, if something goes wrong, you basically lose everything. So for us, it was more about looking at that diversification and saying, okay, I want to have my portfolio be whatever, my personal portfolio, 70-30. I take the 30 and I'm going to split that 30 up between different assets and then even in different investment types. So you talked about angel investing or venture capital. I do both. I've invested in venture capital. I do some angel investing, but I do it on a much smaller portion of my portfolio because I know I'm taking on higher risk when I'm doing that. There's a chance that I can get a massive payout, but there's also a chance that I'm going to lose everything. So I'm looking at it that way, and I'm allocating out my personal portfolio that way. And we devised our fund to be the same thing. So we don't necessarily have a debt fund. We have a fund that holds both debt assets and equity assets in it. So we do both. But primarily because, again, my personal portfolio, I wanted a 70-30 mix. 70% of everything that we bring into the fund is probably closer to 80% of everything we bring into the fund is debt related.
Very cool. Very, very cool. Chris, help us understand what is a typical check size and how do how do you look at businesses who are wanting this money or any fix and flips who are wanting this money from you? How do you evaluate them?
So for the most part, you just probably research hard money. I mean, that's basically what it is. And hard money is basically money lent against a hard physical asset. The biggest thing we vet is the actual physical asset itself. You talked about how much money, like the minimum size. It depends on the asset and it depends on physically where it is. We like to stay around the median price point of the asset in any specific market because we do lend in a few different markets. So we lend in Utah, Idaho, Texas, and Hawaii. And obviously, Hawaii median price point is one, depending on where, but roughly about 1.1, 1.2 million. Median price point is in Texas is roughly about almost 400,000. Median price point in Utah is closer to 550,000. So it's different depending on the market that you're lending in. But typically, we want to stay around that median price point range because I can exit out of the property significantly quicker. As far as underwriting, again, we're looking more at the asset. So I'm trying to determine when I'm looking at it, if anyone who wants to look at it, it can be done by anybody. If you want to look at it, you're going to typically first vet out the asset. It's a little different. On the equity side, I would recommend first vetting out the general partner and the sponsor and then work your way backwards because at the end of the day, it's all mathematical. When you're looking at trying to physically look at the asset, but it's the same. It's honestly the same thing for debt. It's a mathematical process to figure out. Okay, what is the value of the property now? What is the value of the property at the end of either the construction build or at the end of the renovation? And you just try to look at and determine exactly what that number is. It's different for every market, and you also got to look is the market trending up, is the market trending down. Typically if it's trending up, I wouldn't recommend using that upslide, but if it's trending down the opposite, I would definitely recommend using that in your future calculation. So when we're looking at it, we're literally looking at the asset and trying to determine what do I think the asset is going to be after all of the value's been added back to that asset. And then we're only lending at a percentage of it. So typically somebody comes in and purchase, they're going to have to put money in themselves. So typically somewhere between 20 to 30% of capital they're going to have to put in, and that capital is at their risk. Our capital always sits in first lien position, meaning that if something happens, we're going to be the first one that gets paid out. And then after that point, if it's a brand new construction, and everyone does it differently, but understand the biggest reason why we created the fund was so I can invest my own personal money. Our first and foremost is to protect investor capital, but I also want to make sure my capital is growing too. So I'm looking at it as far as when we do a brand new construction, typically there's zero money up front for us. I mean, unless there's a land acquisition, and for us, land has to be entitled, has to be zoned, has to be ready to start going vertical or horizontal or vertical, depending on what's needed. Once that's done, we're looking at it from the standpoint of, okay, I'm going to lend out, just say $500,000, but I'm not going to give you $500,000 until you start doing improvements to the property. Once you start doing improvements to the property, I go and verify and validate improvements, then I bring the money in. So the money that we have is protected both by the equity position that the borrower sits in, plus from escrow account reserves that we have set on the side for future work that's going to be done. So when you're looking at it, and I mean, I would want to advocate this as much as possible, even if it's not with us. Like, again, financial advisors could not have gotten it wrong for the last 40 years. You want to be able to allocate your risk out there. You want to be able to allocate some where you're taking on less risk. And it depends on where you're at personally. Obviously, if I was 21 years old, maybe then I'll have 20% in debt and I'll have 80% risky in equity, and maybe I'll have a 20% split instead of the 5% that I currently have in venture capital, because again, I have a longer time horizon to be able to invest. If I manage to lose everything, my horizon is long, that I can build it all back up. So I would want to be a proponent for that diversification, and everyone should have some sort of debt in their portfolio. I'm not saying real estate debt, but have some sort of debt, money market, treasuries, something in their portfolio. And that portfolio mix should be predicated off where they're at in their investment journey.
Very cool. A lot of great advice there, Chris. Hey, you talked about a couple of your kids, hey, them being in Phoenix and Oregon. talk to our viewers a little bit about who Chris is and hey, how you met your beautiful bride, Harmony.
Oh, my kids are older, so we met. We just celebrated 28 years together, married.
Very
We've
nice.
been together for over 30 years, and we met in Hawaii. We were both working together at I don't know if anyone knows it, but it's Kmart. Again, I've been in retail the bulk of my life. So I was a manager at Kmart, and we ended up meeting there. And my beautiful kids, we decided to have kids when we were younger. Our kids are older, and like I said, they're moved out on their own. They have grandkids now, but it's one of those things where we knew I met my wife and I knew I wanted to be with her for the rest of my life. And I know that doesn't always happen. It was just one of those things for us where it felt right and made sense for us. She had some medical issues early on. I mean, she still has them, but she had medical issues early on where the doctors actually told her she wouldn't have kids. So we decided to start really early and young, and lessons learned from. There's no right or wrong way to do it at all. So I think when you're younger, you probably make more mistakes. I would assume you make more mistakes. As you get older, you start to learn from those mistakes and hopefully don't repeat it. But we definitely were not in the financial situation we are now. Both my wife and I worked really hard. Again, I worked my way up the corporate ladder. I even remember a time, my kids do not remember this because they were too young, but I remember a time when we were first starting out. My kids were younger. I want to say my daughter was probably 2 and my son was 3 at the time. And I remember writing a letter from Santa Claus saying that unfortunately presents aren't coming this Christmas, but they will be here in a week or two. The Santa just couldn't make it. So and it was a lot different time back then compared to where we are now. We were fortunate. I was again fortunate. I mean, I did a lot of hard work. I put myself through college, multiple different schools as well, and worked my way up through the corporate ladder again. And when we decided to retire or get financial or freedom from the 9 to 5, we were in a point where we could invest, and we could get a lot more active in our investments. So it's different for everyone. I mean, I wish everyone could experience, and I wish. I mean, I'd say probably one of the things I wish I would have started like being a lot more active in my investment when I was younger. I did the normal. Again, got the corporate job, had a financial advisor advising me on my investments, and it just wasn't lined up. I remember I had him for almost 12 to 15 years. I don't remember the exact amount, but I remember looking back at the investments that he was doing and the aggregated amount that he was earning, and I think it wasn't even 5%. It was a very small nominal amount, and I remember thinking to myself, "Oh man, I must be able to do better than this. I have to be able to do better. Even if I fail a few times in the beginning, I'll be able to do better than this." So I mean, I think that's another lesson for people to look at your retirement. I mean, there's like $44 trillion out there, some outrageous amount in money just sitting idle or not earning the full potential of what it could be. So looking into alternative assets would definitely be a recommendation I would definitely have. But it's been it's been a great life. I've had a great life. We've been fortunate enough to most of what we do for real estate now is to support our philanthropy work that we do. So we have a nonprofit in Africa where we bring economic opportunities to different countries that can't get those opportunities. We primarily do virtual work, but we're doing stuff with agriculture, looking at different aspects there. Hopefully in 2026, we're actually going to open up our first university in Cote d'Ivoire, Africa. But it's it's been phenomenal. It's been a phenomenal life, ride, and journey, and I can't wait to see what the future has for us. In fact, one of this artwork behind me is from Africa. That's another thing that we do is we go down to local art shops, and we'll purchase the art from them, and then we'll come back here, resell it under the nonprofit, and then whatever proceeds we get, we actually donate back to, or a portion of it back to the artist. So there's a lot of different things that we're doing, and trying to be able to grow. But at the end of the day, I think it's just about making the world a little bit better place than it was yesterday or the day before.
Chris, very, very inspiring, man. Philanthropy, hey, we're helping the people in Africa, going to the art. Wow, hey, you do it all, man. Hey, and plus, hey, I've met your beautiful wife several times at a bunch of conferences. She always supports that Hawaiian flower all the time.
Yes,
Hey, this is phenomenal. This is a great conversation here, my friend.
I appreciate
Hey,
it.
yep, no, and I believe, I think you have a couple of partners as well, and hey, I think I've also run into Zasha all the time as well in a bunch of conferences, right? And so she's your partner, I believe.
Yes, Zasha's one of our partners. Yes.
Very cool, very cool. No, hey, it's this has been a phenomenal conversation. Any parting thoughts here, Chris, for our viewers?
No, I say again that the biggest I regret I ever had was not getting into it sooner, or at least educating yourself. The one thing I do like to say is, no, at the end of the day, no one's going to care more about your money than you do. So taking action is, I think a lot of times people, they, I don't know if it's a set it and forget it, or I'm not 100% sure it is, but I don't think they put enough. And I was there too. Like, I didn't. I had a financial advisor for 12 to 15 years. And I trusted, and he was a really good guy. Don't get me wrong. I'm not definitely not bashing financial advisors. In fact, I have some of my portfolio with a financial advisor that invests in the equity market. So it's not that, but learn. I would say educate yourself as much as possible, and then try to take some action. I don't think if you're taking action, there's nothing wrong you can do. Even if you lose in the beginning, which I have, I'm sure we all have. We all have our stories on it. But taking action and learning and growing and getting better is just going to help you develop yourself that much further. And then hopefully we have 11-year-olds out there that are listening, that are going to be just like Warren Buffett, start investing at 11 years old. By the time you're 94, you have, I don't know what he has, some godly $84 billion or
$1 trillion, yeah.
whatever it is. Yeah. So
No, no, that's amazing advice, Chris. And I tell my kids all that as well, right? Hey, even if you look at it, right, even if we double our money in every 5 years, which is 17% IRR, hey, you start with $50,000, and if you have that chain going every year, if you start 50,000, invest $50,000, after 5 years, you'll that 50 will be 100. After 10 years, that 100 will be 200. Another 5 years, that will be 400, and then after 20 years, that 50,000 would be $800,000. And if you did that every year,
yeah.
by the time if you started investing at 22, 23, by the time you're 40, 42, 43, you'll have several $1 million in your retirement account or your bank account.
It's interesting, I just look at, there's a Warren Buffett wealth chart. I will just Google it if you guys are listening out there. Just Google it and see the real compounding effect, because forever it's very small, minimal growth until you start hitting this. Then you start seeing gigantic spikes towards the end. But I mean, hopefully we get enough people educated, and I love what you're doing. I think us getting more of the education out there is really what we need, and is what's deserved. I wish they did more education like this in school so they can understand. I think we do. I mean, we have some basic finances, but like just understanding investing in general, I think is super powerful. And I love what you're doing. I love what other people are doing out there, just to get the education and the word out.
Great. Thank you, Chris. Mahalo. Hang loose, guys.
Mahalo. Thanks, Akash. I appreciate it. Thanks for having me on, and look forward to seeing you again sometime in the near future.
Absolutely, sir. Thank you.